Hi, in this video I'm going to look at growth investing and value investing. They're two terms that are quite often used. You'll hear them from fund managers and various pundits and commentators. They're nice, useful concepts. So in this video I'm going to explain what they mean, and I'm also going to look at whether right now in 2014 it makes more sense to be a growth investor or a value investor. So let's dive in and look at what a growth investor is. Now, a sort of caricature might be someone who buys high and sells even higher. You buy a share that looks expensive, but it doesn't matter because you can sell it at an even more expensive price a couple of years down the line. Now, that's a bit unfair, but there's some truth in it. And perhaps a more sort of reasonable, down-to-earth definition of growth investing is to say you're looking for companies that are growing faster than the economy and are also growing faster than your average company on the stock market. And so when you're looking at that growth, when you're trying to measure that growth, you're going to look at things like profit, cash flow, and above all else, revenue. In fact, some growth companies won't even be making profits, won't even be generating cash flow. And that doesn't matter. If you can see fast growth on the revenue line, you may think it's worth investing. And then a few years down the line, the profits and the cash flow will come, the share price will go up, and you'll make a nice big profit. Another characteristic for growth companies is if they are making profits, they typically reinvest most or all of those profits back into the business. The management of a growth company is saying, we could pay you a dividend, but we think it's better for you in the long term if we reinvest the money in the business now. That will lead to bigger growth and more profits in the long term, and that'll mean even bigger dividends, even bigger share price rises for you as long as you hang in there and stay invested. Now that's all fine, but the fact that you're reinvesting profits and the fact that you're buying at a relatively expensive price in the first place means that growth investing is often riskier than value investing. But it can work very well. I mean, it worked especially well in the late 90s when we saw a lot of technology companies perform really well, people like Dell and Microsoft and Amazon. But do bear in mind, it's not just technology companies that are growth companies. You'll often see other companies, like Hargreaves Lansdown here in Britain over the last few years, has grown at a phenomenal rate as a company, an amazing business. And, it's also done really well for shareholders. And yet, at just about any time since it's been listed on the stock market, if you tried to value Hargreaves Lansdown on a price-earnings ratio, it's looked expensive. But because the business has been doing so well, actually the share price has carried on going up and investors have still done well. One last thing I'd say is it's not always the case with growth companies that you're buying in high, you're buying at an expensive price. Normally that is the case, but occasionally you'll get really lucky where you'll be able to see a growth company that is set to grow really fast over the next 10 or 20 years. But actually the share price right now is remarkably low. And you're almost then getting a win-win where the share looks cheap now, yet it still is going to grow at a fantastic rate. Now let's look at value investing. With value investing, the adage is buy low, sell high, which obviously makes a lot of sense. It's just the problem is actually finding those cheap companies to buy into. Value investors, they're often looking for companies where the market value, the share price, is lower than the intrinsic value of the business. But again, just like buy low, sell high, that sounds great, but it's easier said than done. How do you identify the businesses where the market value is below the intrinsic value? Well, value investors, they often look at the dividend yield. If a company's paying a yield of 4, 5, 6%, that's a good value signal. They'll also look at the company's net assets, its property, also its intellectual property, its trademarks, its patents, any holdings it has in other companies. If the net assets of the company are below the company, if the net assets of the company are greater than the company's market value greater than its share price, that is potentially a great value play. We often measure that using the price-book ratio. Book is really just another word for net assets. So we want to have a company where the share price is either below book value or not that much above it. That's a good value signal. Do be careful though. Sometimes with shares that look like good value shares, the market may be right. The company is cheap for a reason, and you may be getting sucked into what we call a value trap. So why do you get these value traps? Well, often it's because the business is facing big structural problems. Right now we think of regional newspaper companies. Obviously, their market is contracting rapidly. You might find a regional newspaper company that looks cheap on the yield and on the net assets and on its price book ratio. But if the business is contracting fast, that in the end is the most important thing, and you as an investor may lose out, not be a big winner. So what should you do now in 2014? Should you be a value investor or a growth investor? Well, we're 5 years into the current stock market cycle, share prices have had a good run, and you'd normally say that's a good time to be in value stocks rather than growth stocks. But I'd be a bit careful. For one thing, I think we should all be long-term investors, so you don't want to get too worked up about where we might be in a 5 or 7 year cycle. We're thinking over 10 or 20 years. I think the other thing to bear in mind is the current cycle is quite unusual. The financial crisis was obviously extraordinary. The banking sector is still behaving in a rather unusual way. So the usual rules about stock market cycles and going in value stocks or growth stocks may not apply this time round. And for me, I just say I'm not going to worry about value or growth. I'm investing for the long term, and some of the stocks will be more like growth stocks, stocks that I would think will grow for many years to come. Some of my investments are more like value investments that look cheap on several metrics. I mean, there aren't that many of those at the moment, but I'm always out there looking for them along with the good growth stocks. So I'm doing growth investing, I'm doing some value investing, and I'm also investing in the market as a whole because I know that stock markets normally go up over the long term. I'm investing in markets as a whole using index trackers, using passive ETFs, and if I take that easy, simple stock market approach, I don't really need to worry about growth or value investing. I'm just investing in the market. So that's all I've got time for this week. I'll be back with another video soon. Until then, good luck with your investing.